Hello and welcome to session 9 of our basic group accounting course. In this session we are going to start to look at fair value adjustments, which are pretty fundamental. You'll see them all the time. So we'll look at simple ones in this session and then we'll look at something a little bit more complicated in the next session. So what is this all about? Well, it all comes from this rule. On the acquisition date, all of the subsidiary assets and liabilities need to come into the group at fair value. Okay, that is a rule. It's in the IFRS, so we need to bring everything in at fair value. However, they might not be at fair value in the subsidiary set of accounts. So they might be in there, for example, at historic cost. So what do we need to do? Well, we need to adjust them. Hence the term fair value adjustment. We are adjusting the asset or the liability from whatever it is in the subsidiary's set of financial statements to fair value. So from historic cost to fair value. And the adjustment is what we need to deal with. Okay, so the simple examples in this session are essentially where we've got an increase or a decrease in the asset value. Okay, so increase in the asset value. So for example, in the question, they'll say something like the value in the sub accounts is 400, but the fair value is 600. Okay, so what we can see here is that in the accounts, it's sitting at 400, but the fair value is 600. We therefore need a fair value adjustment. We need to adjust it from the 400 up to the 600. So fair value adjustment of 200 is required. Okay, so we've got a fair value adjustment of 200. What do we do with it? Well, we debit first of all PPE on the statement of financial position. Okay, so when you're adding across the assets, the PPE, you would add in another 200. So we're going to increase the asset by 200 on the statement of financial position. Okay, so that's the first step. But of course, any debit needs a credit. The credit is going to be in our equity table. We increase the net assets on acquisition, and we do that in working to column 1. Okay, so where's that going to go? So here's an example. So working to column 1, we have a fair value adjustment here. So for my example, I would be putting it in here. So that would be an adjustment of 200 to increase the net assets on acquisition. So when I add that up, the increase is going to be reflected in the total. Now, unless the asset is sold, we also put it in at the year end. Okay, so we do it on the acquisition date, which is this adjustment here. And then unless it's been sold, we're going to do it again at the year end, just to make sure that it's still reflected in the group financial statement. So the 200 would be in there as well, and that's for this bit here. Okay, so that is a fair value adjustment. We are adjusting the asset from its value in the subsidiary financial statements up to fair value. However, if you think about it, if we've increased the asset, that is going to have an effect on depreciation. So we are going to have additional depreciation in our example. So due to the change, an increase or a decrease if it was a decrease in the asset. Now this is only required on the adjustment. So the adjustment divided by the useful life times the number of years since the acquisition. So let's add a little bit more information to my example. So for example, the PPE above had a useful life of 4 years. and the acquisition date was 2 years ago. Okay, so we adjusted the PPE up here for 200. It had a 4-year useful life and the acquisition date was 2 years ago. So the adjustment was 200. The useful life is 4. And the years since acquisition was 2. Okay, so 200 divided by 4 is 50. It's been 2 years since acquisition, so that means we need additional depreciation of 100. Okay, so that's how you do the adjustment for additional depreciation. Now, be careful with it. Where does it go? Well, it takes time for the depreciation to happen. It will go in at the year end. Okay, so that's it there. So my adjustment in there for the additional depreciation would be 100 to reflect the 2 years worth of depreciation between the acquisition date and our year end date. So we adjust the asset up, we then do additional depreciation, and then we just add it all up as usual. It'll be reflected in our post-acquisition profit over on the right hand side here, because we'll have the movement on the accumulated profit. We'll then add across our adjustment, or well, we'll have our adjustment here, which will be 0 change in the fair value adjustment, and then we'll have our depreciation here. Okay, so it'll all work out and give us the post-acquisition profit, including the additional depreciation, which of course will hit the P&L. So we just follow these steps and this will give us the correct answer. So we need to adjust the asset at the acquisition date and the year end date. We need to allow for additional depreciation up to the year end. We add it all up and that will give us our post-acquisition profit. Lastly, don't forget that you would also have to include the additional depreciation on the statement of financial position. Up at the top here, we increased the asset by 200 on the statement of financial position. Well, by the year end, we'd have had additional depreciation as well, so that will reduce the asset. Okay, so adjust for the additional depreciation as well as the fair value adjustment. Okay, so adjust it for the fair value change, then work out your additional depreciation and make that adjustment as well. Right, look, as with all of those things, we need to have a look at this in a question and that will make it clearer. So let's look at illustration 7. Okay, as per usual, I've got this in our Excel workbook. So we've got a pro forma ready to go. What we're being asked to do here is just what I've done. So we're going to bring in our equity table. So we'll need to pick up the figures for it from the question. Then we'll need to put our fair value adjustment and our additional depreciation in like we've just done. And then we'll have a look at what it looks like on the statement of financial position. So if you're confident in what we've just seen, you could have a go at this. So if so, pause the video now, see if you can pick up the figures for the equity table and then do the fair value adjustment. If not, we can work through it together, but if you're going to do it, pause the video now, have a go, and then work through it with me. Right, okay, let's have a look at this. Remember, when we're doing our equity table, we always start with what we know. In this case, they give us some detail up at the top here about the acquisition date. We're preparing the statement of financial position. So let's pick up first of all for our equity table, the 900 and 200 of share capital and accumulated profits at the year end. So remember, we always start with those. We We plug those in. The share capital then never changes, so we put that in here. And then we can start picking up the information. So they acquired 80% for 800,000 when the accumulated profits were 150. Okay, so that's going to be 150 at the acquisition date for our retained earnings. At the acquisition date, the carrying value of some PPE was 300, but the fair value was 400. So we need to move from 300 to 400. So that's going to require a fair value adjustment of the difference between the two. So remember, it's moving it from the carrying value to fair value. So fair value adjustment is going to be the difference between the 400 and the 300, which is going to be 100, of course. Okay, where does it go? So we go in here, we go fair value adjustment. 100. It does not say it was sold by the year end, so we need it at the year end as well. And then we need to look for a useful life. So it says here the item had a remaining useful life of 5 years. We're preparing the financial statements for 31st of December X1, and it gives us, so there's 31st of December X1, and it gives us an acquisition date of 1st of January X1. So that's 1 year. Okay, so that means that the additional depreciation is going to be the fair value adjustment, which was 100, divided by the useful life, which is 5, multiplied by the number of years since the acquisition, which is 1, which means we're going to need additional depreciation of 20,000. Okay, so additional depreciation is going to be 20,000. Remember, it takes time for that to happen. It won't have happened at the acquisition date. We can only put that in at the year end date. So that's going to be minus 20 there. That's our fair value adjustment. We can then just work out everything in our equity table. So the net assets at acquisition are going to be this. By the year end, they've moved to this. The movement, well, no movement on share capital. The retained earnings have gone up by 50. No movement on the fair value adjustment. The asset is still there. And then the additional depreciation is 20. So if we add this up at the bottom, that will bring in our movement on retained earnings and the adjustment for the additional depreciation, so that our post-acquisition profit is going to be 30. So it will all work out and give you the correct post-acquisition profit if you do it this way. So that's what we're aiming to do. Okay, so that's our equity table. Finally then it says do the PPE line. Well, PPE before adjustment for the two entities is this. So remember, we add across the non-current assets. So we had 700 for the parent, we had 500 for the sub, but we now need to bring in our adjustments, because remember, the fair value adjustment of 100 for the fair value adjustment less the depreciation is going to be total 80,000, and then when we add across, we've got 1280. Okay, so don't forget that by the year end, this adjustment at the bottom here, sorry, this one is the other side of this. Okay, so we are debiting and crediting the statement of financial position, and we're debiting and crediting the equity table as well. So you need to do both things in order to get all the marks available. Okay, so that is our introduction to fair value. The key thing to remember is everything in the subsidiary needs to come into the group accounts at fair value. If it's not at fair value, it needs to be adjusted to fair value, and that might result in a change in depreciation as well. In the next session then, we'll go on and we'll look at some other fair value adjustments that you'll need to look out for.